Walk down any busy financial district today, and you will overhear anxious conversations about the rising cost of living and unpredictable global markets. Everyday people and seasoned professionals alike are desperately searching for reliable ways to protect their hard-earned wealth. This brings us back to a proven historical solution. The traditional foundations of diversified portfolio construction have entered a severe period of systemic reevaluation across the global financial landscape. For many decades, the 60-40 equity to bond allocation served as the reliable bedrock of institutional and private wealth management strategies for millions of cautious investors globally. This classic approach was deeply predicated on the reliable inverse correlation between risky assets and high-quality fixed-income investments. However, the sudden emergence of a completely new macroeconomic regime, characterized by persistent inflationary volatility and geopolitical fragmentation, has dangerously exposed the inherent vulnerabilities of this old model. In this highly uncertain context, physical gold has proudly reasserted its vital role not merely as a temporary tactical safe haven. It acts as a permanent strategic anchor and critical infrastructure component of a diversified portfolio that provides immense resilience across various economic cycles and absorbs sudden systemic shocks. Furthermore, this precious metal completely eliminates the massive counterparty risks that are deeply inherent in the modern credit-based financial system. The reliability of the traditional 60-40 portfolio was fundamentally tested when the global economy shifted abruptly away from the long peaceful period known as the Great Moderation. During that difficult period, the simultaneous decline of both stocks and bonds shattered the basic assumption that government debt would always provide a protective hedge. When persistent inflation becomes the primary source of market volatility, the correlation between equities and fixed income often turns positive to the detriment of investors. Both asset classes respond quite negatively to the looming prospect of a much more aggressive monetary stance and rapidly rising discount rates. The most critical attribute of an effective portfolio anchor is its complete statistical independence from traditional financial assets during times of severe economic panic and extreme market distress. Detailed analysis of long-term market returns clearly demonstrates that gold bullion maintains a near-zero correlation with both stocks and bonds across multiple decades. From 1973 to 2024, the correlation between gold and equities remained at approximately 0.01 for the period. Meanwhile, its correlation with traditional bonds was recorded at just 0.04. This distinct lack of co-movement is definitely not accidental, but stems from the fundamental drivers of the value of gold, such as real interest rates and sovereign credit risk and global market liquidity across the world. These unique drivers remain entirely distinct from the corporate earnings and interest rate cycles that usually dictate the performance of traditional securities. This impressive data underscores that gold does not merely act as a reverse stock, but rather functions as an entirely different category of protective asset for cautious investors. While the United States dollar exhibits a moderately negative correlation with gold, reflecting the role of the metal as an alternative to fiat currency, its independence from the primary components of conventional portfolios is what allows it to enhance risk-adjusted returns successfully over very long periods of time. The crucial role of gold as a dependable portfolio anchor becomes most visibly apparent during dangerous periods of severe tail risk. In these highly volatile situations, traditional market hedges tend to fail miserably, leaving investors exposed to massive catastrophic financial losses if they are not adequately prepared for such events. In the worst 20 quarters for the broader equity market since 1967, gold proudly delivered positive performance in 15 of them. On average, during major market disruptions over the last half-century, gold has outperformed equities by approximately 16 percentage points, returning a strong positive 14% overall. During those exact same turbulent periods, equities declined by 2% or more, causing severe distress among poorly diversified modern investors. This incredibly consistent counter-cyclical behavior is absolutely essential for effectively minimizing permanent impairment to capital during highly disruptive financial events that periodically shock the global economic system. The tremendous mathematical advantage of deliberately including an uncorrelated asset like physical gold can be clearly expressed through the standard portfolio variance formula. Given that the correlation is effectively zero, the strategic inclusion of gold reduces the overall portfolio variance much more efficiently than adding more volatile stocks or bonds. Traditional assets frequently exhibit dangerously higher correlations during a severe systemic crisis, making them completely unreliable as standalone protective portfolio hedges. This drastic reduction in volatility directly improves the Sharpe ratio, which expertly measures the highly desired excess return generated per unit of risk taken by the individual investor. Extensive analytical studies have definitively shown that even a relatively modest 5% allocation to gold can substantially improve a portfolio Sharpe ratio. Specifically, it can boost this crucial performance metric by a remarkable 12%, offering a much smoother ride for those navigating turbulent and highly unpredictable financial markets. As the obvious limitations of the 60-40 model became widely evident, institutional strategists began advocating for a massive fundamental departure. A modern framework comprising 60% equities, 20% fixed income, and 20% precious metals represents a monumental paradigm shift away from outdated wealth management and asset allocation. This innovative approach moves completely away from treating physical gold merely as a temporary tactical emergency allocation during rare periods of stress. Instead, it fully integrates the precious metal as a mandatory permanent portfolio infrastructure component, uniquely designed to weather the most severe economic storms and protect generational wealth robustly. The decisive move toward a substantially higher gold allocation is powerfully driven by a growing widespread recognition among modern investors. There are massive structural risks inherently built into the highly leveraged modern credit-based financial system that continuously threatens the stability of traditional assets and conventional retirement portfolios across the globe. Most popular traditional assets, including bank deposits and corporate bonds and government debt, fundamentally represent the uncollateralized liability of another entity. In stark contrast, physical gold is a supremely liquid tangible asset that exists completely outside the fragile liability structure of national governments and central banks around the entire world. It rightfully carries absolutely no inherent credit risk and strictly cannot be defaulted on under any imaginable geopolitical or economic circumstance. This extraordinary characteristic is increasingly valued by astute institutions as global sovereign debt levels and runaway fiscal deficits continue to expand at a truly unprecedented and highly alarming pace. This crucial outside money characteristic is particularly relevant today in an increasingly multipolar world fraught with escalating geopolitical tensions. Such severe global conflicts can rapidly lead to the direct weaponization of the international financial system, trapping investors who rely solely on digital or paper assets that depend on foreign goodwill. The absolute neutrality of physical gold means it cannot be printed into oblivion or sanctioned by any centralized governing authority. It masterfully anchors a portfolio against regime-level instability and unpredictable non-economic shocks that traditional sophisticated risk models consistently fail to capture or mitigate effectively during moments of extreme panic. The long-term compelling case for gold as a portfolio anchor is fundamentally tied to its enduring historical role. It acts as a supremely reliable store of value, protecting purchasing power across generations, regardless of which fiat currency happens to dominate the global economic stage during any given historical era. Since the complete abandonment of the restrictive gold standard in 1971, the metal has seen massive growth. It boasts an impressive annual growth rate of nearly 8% in United States dollar terms, firmly cementing its status as a highly lucrative asset rather than just a stagnant defensive play. This outstanding performance is absolutely not merely defensive in its nature, but actively rivals the returns of many assets. It competes exceptionally well against highly touted growth-oriented asset classes, while continuously providing an ironclad hedge against the systematic destruction of underlying purchasing power through reckless monetary expansion and reckless printing. In dangerous periods of high inflation above 3%, the gold price has historically risen at a rapid pace. It averages an incredible gain of over 15% per year, significantly outperforming its smaller 5% average gain during quieter periods of low inflation and macroeconomic stability across markets. This immense responsiveness to extreme price pressures ensures that a well-constructed portfolio maintains its real purchasing value. This holds entirely even when the nominal face value of fiat-denominated paper assets is being rapidly eroded by the reckless fiscal largesse of central planners trying to stimulate failing economies. The stellar reputation of gold as an impenetrable anchor is heavily supported by its observed behavior across varying economic regimes. It reliably protects investors during brutal recessions and crippling stagflation, as well as during sudden systemic financial crises that wipe out trillions in paper wealth almost overnight without warning. Between 1973 and 2020, there were exactly 8 highly documented United States recessions that caused panic. In 6 of these 8 distinct instances, physical gold massively outperformed the broader equity market, beautifully illustrating its unquestionable counter-cyclical strength when traditional investments plunged violently into the red. The tremendous outperformance of gold during economic recessions is very often a direct function of the subsequent fiscal responses. It is typically driven much more by the panicked monetary easing rather than the initial economic contraction itself, which usually terrifies unprepared market participants into making foolish, impulsive financial decisions. As the vulnerable economy quickly enters a sharp downturn, panicked central banks typically pivot toward rapidly lowering borrowing interest rates. They immediately begin injecting massive amounts of artificial liquidity into the system through aggressive quantitative easing programs to desperately prevent a total collapse of the fragile underlying credit markets. Simultaneously, desperate governments often adopt classic Keynesian principles, characterized by heavily increased public borrowing and massive uncontrolled deficit spending. The rare historical exceptions to the typical recessionary strength of gold remain incredibly instructive for modern investors seeking to deeply understand the nuanced mechanics of global macroeconomic forces and asset pricing. In 1981, the metal noticeably underperformed simply because the Federal Reserve aggressively raised interest rates to astronomical levels. This intentionally brutal policy effectively combated runaway inflation, while simultaneously making high-yielding government bonds temporarily more attractive than holding non-yielding physical gold in a high-rate environment. In highly fragile modern contexts, however, the ability of central banks to replicate those historical rate hikes is severely constrained. Extremely high global sovereign debt levels dictate that any such dramatic intervention today would undoubtedly lead to a complete systemic financial collapse across all major highly leveraged global debt markets. This precise dynamic effectively makes physical gold a massive structural beneficiary of the current inescapable global debt trap we face. Analyzing the 7 major crisis periods deeply from 2007 reveals that gold bullion consistently returned an average of nearly 15%, securing its reputation as reliable insurance. This compelling historical data dramatically reinforces the core anchor thesis that modern portfolio managers increasingly rely upon for absolute safety. During terrifying moments of peak fear and rapid institutional deleveraging, massive amounts of capital instinctively seek refuge in proven assets that carry absolutely no underlying systemic counterparty risk whatsoever. Specific geopolitical instances, like the shocking United States sovereign debt downgrade, saw gold rally immensely, while broader equity markets suffered. These dark periods perfectly highlight the unique role of physical gold in providing vast amounts of crucial liquidity precisely when other paper markets freeze completely shut without warning. During the brutal global financial crisis, gold was one of the very few liquid assets that could be sold easily. It allowed investors to meet punishing margin calls on other failing positions without realizing catastrophic losses, effectively acting as a desperately needed portfolio stabilizer during a period of maximum terror. The turbulent years of 2025 and 2026 marked a truly significant evolution in markets. The precious metals market transitioned quickly from reacting to immediate geopolitical shocks to deeply pricing in the long-term macroeconomic consequences of a rapidly shifting and highly unstable global order. This dark period was heavily dominated by severe energy supply disruptions, demonstrating precisely how gold anchors a vulnerable diversified portfolio. Early in 2026, gold violently surged above $5,300 per ounce, entirely driven by unprecedented safe haven demand following massive escalations in global conflict. However, the highly anticipated subsequent ceasefire and the rapid reopening of critical shipping lanes did not collapse underlying gold prices. Instead, the broader market entered a unique macro pricing regime, where the elevated price of gold accurately reflected the deeply embedded inflationary costs of the severe disruption that had occurred. The stunning implications for professional portfolio managers worldwide remain incredibly profound today as they try to navigate this new reality. While any immediate war premium may quickly fade, the massive disruptions to global logistics create a persistent memory of the shock that stays firmly embedded in long-term inflation expectations. Physical gold essentially serves as the primary tangible asset through which the terrified market reads these vast unseen systemic consequences. Even when the immediate localized tail risk is entirely removed, the massive structural impact on energy prices consistently supports a much higher fundamental price floor for the precious metal worldwide. During this highly complex transition, the specific underlying relationship between gold and traditional macro variables remained rather nuanced and complex. Historically, higher real rates reliably increase the painful opportunity cost of holding gold, but recent volatile periods have clearly demonstrated that this outdated relationship is no longer an absolute certainty. If central bank interest rates are rising rapidly because of severe systemic risk or vast fiscal instability, gold can appreciate. It functions as a robust frontline financial insurance mechanism, shielding wealth against the sheer incompetence of central planners, who repeatedly fail to contain the massive economic crises they directly created. The monumental shift in global capital allocation powerfully reflects a deeply rooted institutional concern about the sustainability of the dollar. As sovereign debt burdens were heavily exacerbated by escalating geopolitical conflicts, massive amounts of institutional capital, increasingly allocated to physical gold, to heavily hedge against massive energy-driven global inflation. Modern investors frequently question whether the traditional historical role of gold is being violently challenged by newer digital assets today. They constantly compare its utility against highly volatile cryptocurrencies like Bitcoin or traditional defensive assets like government debt, hoping to find a magical technological solution to age-old macroeconomic problems. In-depth, meticulous analysis of historical crisis behavior consistently and undeniably suggests that physical gold remains the superior portfolio anchor. The intense public debate over gold versus Bitcoin reached an absolute fever pitch recently, as both asset classes experienced massive unprecedented surges in speculative interest from retail and institutional participants. While both unique assets share basic traits such as underlying scarcity, they diverge sharply in their fundamental performance during stress. Bitcoin is dramatically more volatile than physical gold bullion and has a highly verifiable track record of experiencing massive, terrifying drawdowns, frequently exceeding 70% during brutal crypto winter cycles. In stark contrast, physical gold consistently reasserts itself as the broadly preferred crisis hedge for the vast majority of professionals. It rapidly attracts massive institutional capital flows when global economic uncertainty peaks, demonstrating its unparalleled reliability as a true foundational safe haven asset that endures through every single market cycle. Bitcoin frequently behaves exactly like a highly speculative risk-on asset, moving in tandem with volatile technology stocks without fail. It dangerously amplifies total portfolio volatility during severe market drawdowns, destroying wealth precisely when terrified investors desperately need stability and absolute capital protection the most to survive the crushing economic storm. Furthermore, Bitcoin faces incredibly unique existential threats, including complex quantum computing risks and the ever-present threat of severe regulatory bans. Physical gold gracefully avoids these modern technological and regulatory pitfalls, relying instead on a proven 5,000-year history of universal acceptance and unquestioned intrinsic value across all human cultures. Traditional safe havens like United States Treasuries and investment-grade corporate bonds reliably provide steady income during periods of normalcy. However, they are subject to highly dangerous liquidity mismatches and significant credit risk during episodes of extreme market volatility that can instantly wipe out years of carefully accumulated fixed income yield. Recent turbulent periods showed unequivocally that corporate bonds can rapidly lose immense value if prevailing interest rates rise without warning. The surprisingly large redemptions in investment-grade corporate bond funds during periods of acute stress perfectly illustrate this terrifying mismatch risk that blindsides complacent investors relying on outdated assumptions. When panicked investors rush to exit massive bond funds, the underlying securities simply cannot be easily sold without accepting concessions. The gold market behaves entirely differently because the immense depth of the global gold market successfully allows for extremely large-scale liquidations, with absolutely minimal overall market impact preventing a collapse. A defining characteristic of the current golden era is the massive structural shift in dominant global demand leadership underway today. Eastern sovereign entities are steadily replacing Western speculative interests, as the primary market drivers effectively changing the fundamental landscape of precious metals, investing for the foreseeable future, and creating unprecedented scarcity. Central banks have officially become highly dedicated structural accumulators, buying gold at a truly breathtaking and historically unprecedented pace. They are intentionally diversifying away from dollar-denominated reserves to significantly mitigate the inherent risk of international sanctions and to fully ensure their domestic monetary sovereignty remains intact against foreign pressures. This persistent central bank buying acts as a remarkably powerful long-term price floor for the entire global gold market. Unlike smaller retail investors who might hastily sell gold during a sudden price pullback, sovereign institutions steadfastly view their massive gold holdings as permanent strategic assets meant to last for centuries.